Would you like to own a slice of one of the best businesses on the planet? Want a yield that beats the market and dividend growth that beats inflation? Looking for a dividend aristocrat that's dropped by 20% and now appears to be on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing industrial gases within a global oligopoly. All of that stuff you use and enjoy every day, yeah, that stuff has to get manufactured. And that manufacturing process usually requires industrial gases like oxygen and nitrogen. Well, only a few global companies out there operate at scale. You know what that means? Oligopoly. You know what else it means? Growing revenue, growing profit, and a growing dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Air Products and Chemicals Inc., which appear to be trading at a significant discount today. Air Products and Chemicals Inc., stock ticker APD, is a major global producer and supplier of industrial gases. They're the largest supplier of hydrogen and helium in the world. Founded in 1940, Air Products and Chemicals is now a $58 billion by market cap industrial gases monster that employs 20,000 people. The company's fiscal year 2021 sales were reported through 4 industrial gases business segments organized by geography. Americas 40%, Asia 28%, EMEA 24%, and Global 5%. Corporate and other accounted for the remaining 3%. Industrial gases are critical input for the manufacturing processes of many different end products. This applies to all kinds of everyday products, everything from electronics to vehicles. Because of the critical nature of these industrial gases, a manufacturer will set up a long-term contract with a reliable provider of these gases. Complex infrastructure is often installed at a site to ensure reliability. This can make it costly and difficult to switch providers later. In addition, Air Products and Chemicals is part of a global oligopoly. 3 major companies in the space split most of the global market share. Layering this oligopoly on top of the critical nature of their gases is a very powerful combination that puts Air Products and Chemicals in a great position to continue growing its revenue, profit, and dividend for many years into the future. To that point, Air Products and Chemicals has already increased its dividend for 40 consecutive years. In fact, they increased their dividend for the 40th consecutive year only days ago. They easily live up to their status as a vaunted dividend aristocrat. Their 10-year dividend growth rate is 10.1%, and they've been remarkably consistent with their dividend increases usually being in that high single-digit or low double-digit area. After the 8% dividend increase that was announced only days ago, the stock yields 2.5%. That yield handily beats the market. It's also 30 basis points higher than the stock's own 5-year average yield. With a payout ratio of 62.9% based on the midpoint of guidance for this fiscal year's adjusted earnings per share, the dividend is secure and positioned to continue growing roughly in line with the business. I like dividend growth stocks in what I would call the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single digit or better dividend growth rate. You can see that we're right in the sweet spot with this one. Looking at business growth, Air Products and Chemicals has increased its revenue from $9.6 billion in fiscal year 2012 to $10.3 billion in fiscal year 2021. That's a compound annual growth rate of 0.8%. While that's disappointing at first glance, the limited top-line growth can mostly be attributed to the company's decision to purposely make the business smaller and more efficient. They put together their 5-point plan, focusing them on industrial gases by jettisoning non-core businesses. The execution of this plan led to spinning off the Electronics Material Division in 2016, as well as selling the Performance Materials Division in 2017 for $3.8 billion in cash. It appears to have worked. Earnings per share grew from $5.44 to $9.43 over this 10-year period, which is a compound annual growth rate of 6.3%. Notably, most of this growth started to reveal itself after fiscal year 2016. That's when net margin started to increase dramatically, so they're doing a lot more with what is effectively the same sales base. Also, it's worth pointing out that the company's GAAP earnings per share can be lumpy. In my view, this number belies their true earnings power. It can be instructive to instead look at adjusted earnings per share in this case. If we look at this, we can see that the company's guidance for adjusted earnings per share for this fiscal year at the midpoint is calling for 14% year-over-year growth. Looking forward, CFRA is projecting that Air Products and Chemicals will compound its earnings per share at an annual rate of 15% over the next 3 years. That earnings per share growth forecast looks high when compared to the company's 10-year demonstrated earnings per share growth. However, again, most of that growth came about after the transformation. And again, I believe that GAAP earnings per share number doesn't fully convey what this business is capable of doing. They're structured to succeed based on providing high value but low cost gasification. They lock in long-term contracts as a part of huge projects within the framework of a global oligopoly. It's hard to overstate how appealing that is. Regarding this, CFRA states the following, and I quote, APD has a solid backlog of growth projects with a focus on expanding the scope of syngas supply agreements, acquiring air separation units, and winning agreements in large industrial gas projects, unquote. Indeed, their backlog is currently at approximately $17 billion. Moreover, new opportunities that didn't even exist 10 years ago are now opening up for the company. CFRA also points this out, and I quote, APD is well positioned to capitalize on gasification related to carbon capture and hydrogen mobility, which are long-term secular tailwinds, unquote. There's also green hydrogen. The company's $5 billion partnership with Saudi Arabia's ACWA Power and NEOM on the world's largest green hydrogen plant in Saudi Arabia is a prime example. Effectively, we're taking what was already a really good business 10 years ago, improving it through additional focus on its core strengths, and then adding on new growth vectors. I think that bodes extremely well for the business and its shareholders over the years to come. And it sets them up to continue growing the dividend at a level that's roughly in line with what they've done over the last decade. With a 2.5% starting yield, you're looking at a great combination of yield and growth here. Moving over to the balance sheet, the company maintains a very strong balance sheet. The long-term debt-to-equity ratio is 0.5, while the interest coverage ratio is over 18. Furthermore, the company has a healthy amount of cash. Profitability is quite robust, which shouldn't be a surprise for an oligopolistic enterprise. Over the last 5 years, the firm has averaged annual net margin of 22.2% and annual return on equity of 19.7%. Speaking on the margin expansion I highlighted earlier, the company was routinely printing single-digit annual net margin prior to fiscal year 2017. This Dividend Aristocrat is high quality across the board. And with global economies of scale, barriers to entry, high switching costs, a global oligopoly, and long-term contracts with fixed infrastructure, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. There is direct exposure to economic cycles via oscillating demand for manufacturing output. The company is tied to numerous large energy projects around the world. Any changes in the global energy complex could diminish the company's long-term growth story. Also, input costs can be volatile. I view these risks as manageable, especially when lined up against the quality of the business. And after a 20% drop from its 52-week high, the stock's current valuation makes it highly appealing right now. The price-earnings ratio is 26.5. That's measurably lower than the stock's 5-year average price-earnings ratio of 28.6. The price-to-cash flow ratio of 17.2 is also showing a slight discount relative to its usual level. And the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate might look high in isolation, however, it's quite a bit lower than the company's long-term demonstrated dividend growth. And I'd argue the company is in a better position now than it was 10 years ago. Also, the dividend increase announced only days ago was right there, even as we're still moving past a global pandemic. With the payout ratio being where it's at, I suspect that the dividend growth will line up pretty well with bottom line growth. Since the company is expected to grow its earnings per share at a double-digit rate for the foreseeable future, 8% dividend growth shouldn't be a difficult hurdle for them to clear. The dividend discount model analysis gives me a fair value of $349.92. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates APD as a 4-star stock with a fair value estimate of $331. CFRA rates APD as a 5-star strong buy with a 12-month target price of $348. We have a fairly tight consensus this time around. Averaging the three numbers out gives us a final valuation of $342.97, which would indicate the stock is possibly 32% undervalued. Here's the bottom line, guys. Air Products and Chemicals Inc. is a high-quality dividend aristocrat that is, in many ways, positioned better than ever before, with a market-beating yield, double-digit long-term dividend growth, 40 consecutive years of dividend increases, and the potential that shares are 32% undervalued. This is a gem of an idea for long-term dividend growth investors to consider adding to their portfolios. And now for a special news announcement. Omnicom Group Inc., stock ticker OMC, just reported a blowout for their Q4, easily beating on both the top line and bottom line. This sent the stock skyrocketing by more than 14% this past Wednesday, leading the entire S&P 500. I picked Omnicom as one of my top 5 stocks for December 2021. It was so cheap, this big bounce simply brought the stock up to a pricing level that's more in line with what looks like fair value. With the stock still offering a 3% plus yield at a sub 15 PE ratio, it could go even higher. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.